Hi, everybody. It's Marcus Collins from MA Properties. So it's July, and so I have 6 months worth of data to pour over. And so in this presentation, I'm going to cover half one, 2024, Lexington single-family home market update. I have to say, I rather enjoy July, and actually moving forward too, because now I've got enough information to start making some predictions that are accurate. In terms of how the rest of the year is going to play out. So I kind of enjoy doing this market update in half one and then in Q3 and so on. So with that, let's get started. So where can I find information? So there's lots of information in this presentation, but perhaps you need more. Perhaps you want condominiums. I'm going to do another presentation on condominiums anyway, but that aside, you want condominiums. Maybe you want to know what's going on in other towns. If you do, then I recommend you go across to maproperties.com statistics, and you'll see a screen like this with lots and lots of different graphs on it, telling you about what's happening in the market in about 50 different towns. Single families, condominiums, 50 different towns. So lots and lots of information there in terms of what's happening, and if you're interested in Concord or Winchester, Belmont, and so on. All of that information is on our website. So feel free to go there and take a look at what's going on in another town that you're interested in. The other place where you can find information, of course, is in our 2023-24 market review. Talks a lot about what happened in the market in 2023, much of which is still applicable in 2024, as it turns out. But also there's the predictions we made for 2024, so feel free to go take a look and see how well I did. So with that, let's look at the agenda. I'm going to look at single-family homes, like I just said, but also then I'm going to look at the kind of wider perspective. What's happening in the external world? How's that impacting the real estate market here in Lexington? Then I'm going to look at, first time I've done this actually, the impact of the multifamily developments in Lexington and what impact they're going to have on single-family, condominium, rental markets. I mean, what's the overall impact of those going to be? So I've not done that on a presentation before, looked at it before, but they're not a presentation. So you might find that interesting. And then we'll take our crystal ball out and take a look at the rest of 2024 and what's going to happen in 2025. So single family homes. Many of the graphs I'm going to show you in this presentation, you've actually seen before, but there's one difference. And let me show you that in the home sales. If you look at the 2024 bar, you'll see a red bar at the top of that. That's my projection for the full year. I've got 6 months worth of data, and the year is skewed somewhat. It's not a 50% home selling in the half one and 50% in half two, more selling half one than doing half two. So we have enough information to start kind of pulling together where we think the full year is going to be in terms of the number of homes. So you'll see that on a number of graphs. See this kind of red bar, which is my projection in terms of where we will be at the end of the year. So, home sales. If you've not seen this before, the blue bar is the number of existing home sales. The green is new construction, and then that kind of orange piece at the bottom is the off-market teardowns. Those homes that don't actually come on the market but get torn down, bought off-market, torn down, and they're converted into new construction. COVID, there were lots of home sales. Clearly, and then it declined after that as people had already moved, so they didn't need to move. But now we're beginning to see the impact of the mortgage interest rates play out more so than I don't need to move because I moved during COVID. And that's having a continual, sizable impact on the number of home sales. It's impacting home listings as well, but it's impacting home sales more. So you can see that number's lower. To put that in perspective, that 300 and 275 home sales that we're predicting for the full year, that's less than we've seen until you go back to the last crash in 2008-9. So this is a very low number of home sales in the town. So we just kind of put that in perspective. So we anticipate being in that kind of 275 number where by the time the year has played out. Interesting to look at 2016 and 17 because that's the last year, and you'll see this in some of the analysis moving forward. Those are the years that we look at to say that's when the housing market was stable. We'd come down from the crash. It was before the discussion of a downturn in 2018, 2019, clearly before COVID. And so we see the normal, if that's the way to think of it, at around about 375 home sales per year. And so running at 275 home sales a year is clearly considerably less than we would expect in a normal market. So we are far from a normal market, right? You can see this lack of home sales playing out kind of real time, if you like. This graph of cumulative sales tracks the number of home sales based on the under agreement date. So backing out that 6 or 8 week period between under agreement and selling and saying how many homes went under agreement during this weekly, actually. And you can see that red area, pink area, is 2024, and the blue area is 2023. You can see we have been, after it, we were slightly higher than 2023 in the early part of the year, but quite quickly, you can see that the number of home sales has declined as the years kind of progressed. So you can see what our projection, if you played out in real time. So that's the number of homes that are sold. But what about the number of homes that are listed? Let's get a sense of seller confidence, if you will. That's running around about where we were in 2023. Now, remember, back to historical perspectives here, we would expect something like about 400, 425 to be the norm. And so running at less than 370, 325 is low. So even though we're tracking the same as last year was the lowest level we've seen in well over a decade. And so we're continuing that low number of homes listed. No surprises, everybody's read. This is the impact of mortgage interest rates, specifically on sellers, whereby they've got a 3.5% mortgage today, and they don't want to swap it for a 7%, unsurprisingly. So a lot of sticky sellers, if you will, because they don't want to swap their very low interest rate for one that could easily be almost double where they are right now. So that's why we're seeing the number of homes listed at this historical low, continuing what we saw in 2023. Turning our attention a little bit to buyers, let's look at a couple of metrics that give us a sense of buyer confidence now. The first one is days on the market, pretty straightforward. How long does it take a home to sell or to go under agreement, The number around about, same as last year, 37 last year, 38 this year, less than we saw back in coming down from the crash, but not discernibly higher than we've seen in kind of normal years, if you will. Lower in COVID, no surprise there. Homes were selling very quickly, but it's not that off from what we would expect in a relatively normal market, implying perhaps a little bit more confidence in the buyer market than we do in the seller sector. Let's look at another ratio, and that's the ratio of the sale price to the list price. Now, imagine a home that comes on the market for $1 million, sells for $1 million. That would be 100% sale price to list price ratio. And so what you can see here is kind of historically, we were around about 100%, give or take. Maybe one year it went to 101, next year 99, but we were essentially at 100%. A home came on the market for a price and it sold for roughly that same price. That's where we were historically. Rose dramatically during COVID, 2021, 2022. And now we're tracking slightly higher. Excuse me. I feel like that politician who leant over to get a glass of water a few years ago. Now we're tracking a little bit higher than historical norms, but not too much higher. I think what that tells us, though, is that there is a little bit more confidence in the buyer community than we're seeing in the seller community. Sellers thinking, I don't want to sell. I'm sticky. I want to sell, but I don't want to because it would mean my interest rate would rise dramatically. Buyers thinking, I could buy now at 7%, but I'm going to chase the interest rates down as they go down through a series of refinances. And maybe some of the lenders are offering free refinances in the next 3 years or so. And so I think the buyers are feeling, yeah, sure, I'll jump in the market today and I'll just chase interest rates down. Sellers are saying, yeah, I don't think I want to jump into the market. And that's what I think we see playing out here. It's interesting to look at this information month by month and compare 2023 with 2024. So let me go ahead and show you this data. This is 2023 tracked by month. You can see relatively high ratios in kind of February, March, April, May, over 100%, and into June. Then it begins to decline. And there are two impacts here as we look at June moving forward. The first is that mortgage interest rates, the decision was made, I guess, by the buyers that mortgage interest rates are not coming down anytime soon. Lots of discussion about lots of rate cuts, none of it materialized. And so there was a realization that, okay, interest rates are going to remain at this level moving forward. And that put a damper on the buyer community. There's also the effect that as you move forward through the year, there are less buyers. Buyers do tend to buy, especially if you think about Lexington, those that are interested in the school system, they do want to buy to enable their children to be in the school system by the end of August. So there is a kind of a natural break there. If I can't get in by the end of August, I really would like to do that. And so what happens is that the sale price to list price ratio does tend to decline as the year progresses. And then once you get to October, November, December, very few buyers are out there. And if they are, they're looking for bargains. And so that drives the ratio down. Long explanation to the graph, sorry about that. So let's kind of track forward to 2024. Higher than we saw at the end of 2023, but similar to what we saw in the early part of 2023. And so it looks like the overall trajectory of this sale price to list price ratio as we look forward through the rest of the year will track very similar to what we saw in 2023, peaking in that May-June timeframe and now declining as the year progresses. So almost they're looking very similar in terms of how that's going to play out through the rest of the year. Let's take a look at, let's break out, I should say, new construction in existing homes. So similar, same data, except blue is existing homes and green is the new construction. As we mentioned, if you look at presentations we did at the beginning of this year and last year, there were essentially too many new construction homes built. After COVID, developers were buoyant, thinking the market would continue that way. It clearly didn't. And so what happened is many of the homes that they built didn't sell for asking price. They sold for less than asking price. And so in order to shift the inventory, if you will, developers were forced to bring their prices, sell for less than it was listed for. And you can see that in the green data. The new construction sale price to list price ratio was running in the mid-90s, whereas the existing home ratio, bear in mind, sellers have some choice here. Perhaps they don't have to move, and so they can put it off to, I didn't sell for what I wanted to for this year, I can put it off to next year. Developers don't have that luxury. And that remained at 100 and slightly higher. So higher for existing homes than new construction. We run that one forward to 2024, we can see somewhat similar data. The blue line is tracking, say, as I said before, similarly to what we saw in 2023. Green is as well. Be cautious with the May data, it's at 104%. That was only 2 home sales. Challenge with doing it month by month, if there are not that many aggregate home sales, is that you can end up with 1 or 2 homes that sell for a lot over asking, and that skews the data. So the 104% you're seeing in May is exactly what happened. That was just 2 new construction homes selling, and that skewed that data. So don't read too much into that 104 graph. The average for new construction is much lower than it is for existing homes, similar to what we saw in 2023. So let's take a look at, I guess, what everybody's interested in, average sale price. So average sale price last year, 1,828. Average sale price this year, 1,970. That's almost 2 million. That's probably its peak. As I mentioned before, we see that ratio decline as the year goes on. And so we can anticipate just shy of $2 million for the average sale price, which is a considerable rise. I mean, even looking through all the way from 2014 all the way through to 2024, that's gone from about 1.1 million to almost $2 million. That's a big increase. Now, some of that is a consequence of luxury homes. I'll talk about that in a moment. More luxury homes selling than non-luxury homes. So a little bit skewed in that data, and we kind of throw the median here and kind of back out that skew. You still see the increase, though. No question, there's an increase. Our median went from 1,675 to 1,777. So a definite increase in average sale prices moving forward. Now, let's take a look at some of the other sectors, and then So first thing is new construction. So this is the number of home sales for new construction. Again, that red piece there is my projection for the rest of 2024. And as you can see, looks like we'll see a lot less new construction home sales in 24 versus 2023. A consequence of the overbuilding in 2022, developers selling them in 2023 by taking a lower price, hence that reduced sale price list price ratio. So that's why we saw an increase in 2023, getting rid of the excess inventory, I guess. Now we're getting back to a number that's more steady state that we'll see after COVID. So no surprise we're seeing less single-family home sales. We may also see, of course, developers being somewhat more hesitant about jumping into the market, building as many as they did, moving forward. So in terms of luxury, it's kind of interesting to look at luxury. 5-7 years ago, we've been doing these presentations on our market review now for, almost a decade. We originally defined luxury as over $2 million. Given that the average is now 2 million, clearly sustainable. 2 years ago, we shifted our definition. It's an arbitrary definition that we decide, but we shifted it to 2.5 million. And so looking at where we are with the average and the increase we've seen, we've decided to move our luxury definition now to be 3 million and above. And so what you see here is the number of home sales. Blue is existing homes, green is new construction, over $3 million. And as you can see, it's risen quite dramatically. Certainly in that 2020, when we were actually at 7 homes, through 2020, 2021, when we were at 19 homes. So that's a big jump there. And it's actually continued to rise. So we're projecting that we'll see best part of 25 new luxury homes selling in 2024, which is higher than we've seen previously. And remembering we're overall anticipating less home sales, more luxury home sales is kind of skewing slightly that average, which is why I wanted to show you the median as well as the average, because this excess number of luxury home sales is having an impact on that average. Interesting to look and kind of give a sense of where the price increases are happening. What showing this graph, the orange, so it's a bit gaudy, the orange. I should change that color, really, shouldn't I? That orange bar is the new construction sales. What we're more interested in this graph is the blue line and the red line. The blue line is the average new construction price. Now, you can see that it rose rapidly till 2022, but then took a decline in 2023 because of overbuilding in that 2022, 2021, 22 timeframe, kind of the aftermath of COVID. Many companies had thought it was going to continue, but it clearly didn't. So price reductions reduced in 2023, but has rebounded now because there are less new construction homes. There are less new construction, actually, listings. And so average price of new construction has rebounded slightly higher than where it was in 2022. We've seen a sharp increase, too, in the average price of non-new construction. That's the red line. You can see that it was pretty static from 21, 22, rose slightly in 23, but that's no more than a 2 to 3% rise over the course of 2 years. So not really very much price appreciation. That changed in 2024 year to date. Anyway, as I said previously, the number we end up with now is probably where we're going to end up with. It may decrease slightly because as the rest of the year plays out, we would expect lower sale price, list price ratio, and therefore, in general, a lower sale price. So anticipate where we are with that, which is about 1.75, give or take, about the high point for the year. It may just decrease slightly to 1.7. But still, no question, a definite increase in price 24 versus 2023. So that's kind of what you see in that graph. So what's happening in the wider world? Then how is that impacting home sales or the real estate market in general in Lexington? So no surprise, mortgage interest rates are the problem, if you will. So here's the data since 2010. You can see as you look at that between 2010 and 2015, interest rates below 3%. And the challenge with that is that's when an awful lot of people bought, coming down from the recession that came out of the crash. So a lot of people bought during that time while interest rates were declining. And they're essentially locked in because as we track forward, you can see that once we get to 2022, 23, interest rates rose dramatically. So kind of a perfect storm here. When many people moved into the housing market after the crash was out of the way, they locked in those low interest rates and they're still there. If I kind of narrow down this graph and look at in 2020, you can see that sharp rise in 2022. It peaked at the end of 23, but the sharp rise was really during 2022. What's interesting is if you look at what's happened in 2024, we did see a reduction. It did drop by 7%, but it's struggling to keep that low number. And every week it just kind of it's like a boring roller coaster, if you will. It just kind of goes up and down like that. That's what it tends to do. And so it isn't doing very much. We really do need to see a sustained reduction in the mortgage interest rates for confidence to return to both the seller and the buyer market, for both. So where do we think the projections are for mortgage interest rates? So a caveat, this data is from the Mortgage Banker Association. The projections are, anyway, the blue is actuals. The green here are the projections, or predictions, perhaps a better word. What I would say is that they are not long-term projections. Those projections change month by month. I track it month by month to see if it changes, and it does. So you look at that 6.3, but last month it could easily have been 6.2, and in fact, I think it was. So there is even though it tracks out to mid-2025, they change that data literally on a month-by-month basis. So don't read too much into this data, I guess is a way I would say. The trend may well be accurate. The timing of the trend is what caught everybody out. And I would say it caught us out too. When I did the market review, I predicted we would have as many home sales, perhaps slightly higher this year than last year, because by reading essentially this information, anticipated that there would be lower interest rates now than they were 9 months ago, or even 6 months ago. And that clearly isn't the case. And so the trend, though, does seem to be downwards. I think the question really is that mid-25 when we're in the mid-6s, or is that the end of 2025? And there's some question about that. We have another big unknown, of course, in this one, and I have some sympathy with the people producing these predictions. We have an election coming up in November. There's an awful lot of uncertainty in that. And from my perspective, looking at it, on the numbers guy, analytically, I don't see anything coming out of the discussion today, which seems to be focused on personalities, not on economic policy. Where do we anticipate? What policies are the parties going to implement should they regain power? And how will that impact, for example, mortgage interest rates? I mean, that's that's lacking. And so I have some sympathy with the guys doing these predictions, because I would struggle to. But trend is downwards. Question, I think, is only not around will it decline. The question is, when will it decline? So what does that mean kind of overall? Well, that means that we're back to, and many of you will have seen this graph before, we're back to the traditional downsizers and baby boomers. This is kind of census information showing how many people are in each age bracket, a kind of population pyramid, as they call it. The yellow bar at the top is the downsizers. You can see a kind of bolus of people moving through the system. And then the lower yellow bar, first-time home buyers, essentially, the millennials, excuse me. And they're looking to move into the housing market while the downsizers sell their existing. And so this cycle, really, I've been showing this graph, probably for say 7 to 10 years now, is really the standard cycle that we anticipate getting into. Interest rates are skewing it, but once interest rates get back to some degree of normality and people realize that, okay, I understand they're coming down, certainly in the medium term anyway, it's not jumping back into the market. It's these effects of the downsizers and millennials, the first-time home buyers, if you like, coming into the market. It's not in Lexington, but in nearby towns, that will drive the real estate market. So that's kind of the wider impact. I want to turn our attention to the impact of the multifamily development. So Lexington has implemented a number of zoning changes that allow more multifamily homes for that REIT condo complexes to be built. And I want to have a look at what's planned and try and get a sense of what the impact of this will be. So first of all, if you go on the planning board's current project website, you will see a large number of current projects. Concord Avenue, 200 units, Piper Road, 59, Merriam Street, Edgewood, 11, Fairmont Commons, 16, and so it goes on. There's a couple of unknowns in that as well. There is the 475 Bedford Street. It's currently in the MFO zone. We don't know what's going to happen. That is the current tennis club. We don't know what's going to happen to that. Is it going to be residential? Is it going to be commercial? It's a question on that. And I don't have much visibility into the affordable housing initiative that's on the intersection of North Street and Lowell Street. But so excluding those for the time being, like I can't put a number around those. I can't rationalize or can't put a number around those. It looks like that we could end up with 425 plus units in a relatively short timescale, 2, 3, maybe 4 years. And say these are current projects, who knows what else will come along, of course. We could end up with, say, anywhere up to 400 plus new units being built in the town. And the question really is, what will the impact of that be? So one thing which I thought was quite interesting, because you may have received as well, as I did, the Lexington Public Schools community report. And so first question I had was, okay, so what's the potential impact of this on the school system? So I used 425. I think it's a low number. I think in the end it will be higher. It could easily be 600 if you think about those other two developments. But let's kind of play with that. Use 425 as our number A. Census data tells us that the average number of children per family in the United States is about 1.94. So it is 1.94, about 2. And so 425 units could mean an additional 800 additional children. Now, I've got some things to say about whether that's additional or whether that's, currently in the town children, but, put that to one side. That's clearly a very high number, right? That would be keeping me awake. I don't know about you, but I would be having sleepless nights over that one. But anyway, and I thought what was interesting in this community report, they said, right at the back, working with the town of Lexington, LPS will continue to monitor local multifamily zoning changes, good, all of which remain a consideration for the longer term planning. And I don't think that's right. I think there is would appear to be a feeling that this is way out there, but I think the impact of this is going to happen sooner than they think. So let's leave that to OPS. Let's look at what the impact will potentially be on the real estate market. So crystal ball stuff at this point. So you've seen this graph before. This is the number of home sales. What I've done here, though, is I've combined single family and condominium. So this is essentially the total number of home sales in Lexington. Now, we do anticipate, and if you bear in mind what I just said for the last 30 minutes, sorry, it's going to take longer than normal. We do anticipate that interest rates will decline. The uncertainty of the election will be behind us in 2025, and therefore more sellers will come into the market as we see this sustained drop in mortgage interest rates. There's kind of a big unknown on timing on that, but I think it going down does seem to be, yes, it will. I just don't know when. And so we would anticipate to see more home sales in 2025 and correspondingly as interest rates decline further through into 2026. I'm not brave enough to go much further than 2026 for obvious reasons. But we would anticipate they increase. Now, how did I rationalize that 350 in 25 and 400 in 2026? So as I mentioned previously, we say that 2016 and 2017 was about as normal a year as we can see. As I said before, it's because we had come down from the crash that had kind of worked itself out of the system. It was a few years before COVID, so that was kind of an unknown. And in 2018 and 19, there was some discussion around an economic downturn. COVID put pay to that, but beside the point. So we see 2016 and 17 as being a normal year. All other things being equal, we should anticipate around about 450 home sales per year in a normal market. Okay. I wasn't brave enough to say we'll get 450 in 2026. I think we might in 2027 as interest rates go down even further, assuming they do. But I kind of scaled that back slightly and said, okay, let's just go with a slightly lower number. We do anticipate it being higher than where we are today, higher than 2025, and I'll run at about 400 home sales in 2026. Okay. Now let's layer on top of that the multifamilies. And so what I did with the multifamilies, that's the purple, by the way. Sorry, it's like multicolored here. So but purple is the impact, the number of multifamily homes coming on stream, basically. And so I looked at around about, if we anticipate over the next 3-4 years, about 600 homes, assuming that's how it plays out, about 150 per year. And ask the question, is this a number that the town, one, can sustain, and what will the impact of that be? So take our 350 sales in 2025, add 150 to that, we end up with about 500 sales. That's the number that we had at the peak of COVID. So we've never seen those numbers before. We just haven't. We had kind of at the end of the recession, almost got there. Bear in mind that that was people coming back into the market because they hadn't bought during the crash. So there was a reason for that. There was also a reason for the high numbers in 2020 and 2021. That is, the home that I'm living in right now doesn't work for me. It's too big, it's too small. I don't need to worry about going into commuting into Boston every day and so on. So there was kind of an external influence, a very sizable one in terms of COVID, of course, that why we saw such a large number of home sales in 20 and 2021. There's no such impact right now in terms of 25, 26, 27 and moving forward. And we've just got declining interest rates and therefore more sellers coming into the market. And so 2025 numbers gets us to the high of COVID. 2026 numbers, bear in mind I was conservative in my projection for 2026, takes us far higher than we've ever been before, right? This is the number of home sales, more home sales than we have ever seen in Lexington year by year. So it's clearly a major impact, or it's going to have a major impact on the market. The question is, where will it have an impact and what will that impact be? So harder to say what the impact will be, but I think it's easier to say what will be impacted. So let's take a look at the areas that we anticipate being impacted by this relatively large is not relatively large, is it? Large number of new homes being built. The first area I think will be impacted will be the residential rental market. And I'll include within that, although it's not in the information we're looking at here. This is, by the way, the number of rentals in Lexington year by year. You can see it there. About 200 over the last 2022, 23, about 200. This does not include the two Avalon developments as well. But we do know that there are a large number of people today, families today, who are renting in Lexington and want to move into a home in Lexington. And so that's one area that I think will be impacted quite severely because this is a kind of clear market. If I'm marketing multi-unit developments, I'm marketing to, first and foremost, the rental community in Lexington. Here is your opportunity to buy a home in Lexington. Relatively affordable, they're condominiums after all, so they are relatively affordable, less than the average price of a single family home, and there are lots of them. And so the ability to charge a premium becomes less so because there are just simply so many being sold. So this is a great opportunity to get out of your rental, out of Avalon, into a home that you own. So it will have a sizable impact both on the residential rental market, but also on the two Avalon developments we have here in Lexington. But let's focus now on single family and condominiums. So interesting to look at, let me take a step back here. What I've done here is done a distribution. Normally I do a distribution based on price, and I'll do that in a moment actually. But let's look at a distribution based on floor area. So how big is, in this case, the single family home? As you can see, the majority of single family homes that sell are between 1,000 and 3,000 square feet. Let's say 1,500 to 2,500. That's where these new condominiums are going to be built. There is little point building a one-bedroom, 800 square foot unit in Lexington because that's not Lexington. Lexington is to a large extent a dormitory town. People come here for the school systems. They commute into Boston, Cambridge, or 95 or 495. That's the demographic, if you will, of Lexington. And so it makes no sense to build one-bedroom apartments. This is not Seaport. We're Lexington. And so the majority of homes that are going to be built will be in that 1,000 to 3,000 size, square footage size, exactly where the existing single-family homes are. If I put the same graph for condominiums, you can see that in general the condominiums are smaller, but the peak, the majority actually, are in the 1,000 square feet range. And so that's there and slightly above is where these new condominiums should be developed, and therefore it will have an impact on the existing condo market when you look at the size of the unit. So now let's look at price. Let's do the same analysis based on price. So this is the sale price distribution. The other was the floor area size distribution. This is sale price distribution for single family homes. There are almost no single family home sales below $1 million. In fact, there are less single family home sales below $1 million than there are condo sales. So that kind of says there are almost none. It's basically in the teens. And so the majority of single family homes sell in that $1 to $2 million price point. That's exactly where the condos that are going to be built are going to be. They're going to be in that price point. The sheer economics of building means that they almost cannot be in those lower price points. So the majority are going to be built in that $1 to $2 million price point. So that's going to have an impact, clearly, because that's where most of the Lexington single-family home sales are, existing homes, by the way. won't necessarily have an impact on more expensive homes, won't necessarily have an impact on the single family new construction market, because they tend to be, one, more expensive, and secondly, larger. And so it will have an impact on the existing home sales here in Lexington, because they're being built in exactly the price points where current single family homes are. In terms of the condominiums, here's the same information, but for condominiums, you can see that there are condominiums selling for less than $1 million. That's the like of Drummer Boy, Pfeiffer Lane, Potter Pond, and so on. They're sub 1 million. The challenge for those condo developments is that they were built a long time ago, and they're beginning to show their age. And so all of a sudden, I've got new condominiums being built, maybe slightly more expensive, but perhaps with a lower condo fee. So maybe I'll save $300 a month in condo fee, and that will allow me to buy a slightly more expensive home. And so even though it's likely that condominiums will be built at a higher price point than the average, if you will, in Lexington, I do think it's going to have an impact on the existing condominiums, purely because of their age, and purely because of the high condominium fees. And so I do think we can anticipate quite a lot of impact on the existing condominium market just because of those two factors. So that's kind of where I am with multifamily today. I think there's a lot more to unpack from this. We'll see how those developments play out. We'll see over what timescale they play out. We'll see what additional ones kind of come in. But I do think this is something that we need to pay attention to. Certainly we will be looking at what the impact of those developments will be on both the residential rental market, single family home market, and the condominium market, because it's likely to be considerable, just given the sheer volume of homes that are going to be built, new homes that are going to be built. So let's finish up with some predictions. So 24, 25. I think we can say with some certainty that 2024 will see less home sales than 2025, a consequence of high interest rates, sellers being very reluctant to put their home on the market, buyers less reluctant, but still a little reluctant. There is, kind of buyer confidence is marginally higher and seller confidence is kind of very low. As we move into 2025, predictions today, again, is that we'll have a single price reduction in 2024. I don't think anybody's brave enough to tell me how many price reductions there will be in 2025. I've not read anybody who's brave enough to do that anyway. The election brings that huge amount of uncertainty on it. So 2025 is a real unknown. If interest rates do decline and decline quite quickly, it's likely that there will be sellers coming into the market at a higher level than 2024, no question. Higher level than 2023, probably, but clearly not, the years prior to that. So, getting back to that kind of normal. If interest rates just kind of meander their way down, sorry, it can meander, but you get the idea, kind of trend slowly downwards, we'll see a much more gradual number of sellers coming into the market, which will inevitably mean that prices will remain elevated because there just isn't enough inventory, excluding the multifamily development for the time being. That probably won't come on stream until towards the end of 25. So early 25, which is kind of as brave as I'm willing to be, looks very much like it's going to be less inventory if those interest rates don't decline as rapidly as we hope, and then prices will remain elevated. So a similar situation to where we are in 2023. So it really all hinges on two things. One, the impact of the election, and secondly, corresponding to that as well, probably, the impact to interest rates. If interest rates decline quickly, expect more sellers to come into the market, expect more buyers to be in the market. If interest rates slowly trend downwards, we'll have less sellers in, less inventory, buyers feeling marginally more confident, we'll have kind of rinse and repeat for 2024. So, thank you for sticking with me. It was way longer than I anticipated, and I do apologize for that. But thanks for sticking with me, and I hope you enjoyed that. Lots of information here. Going to kind of keep this up to date as we move forward through the rest of the year. If you have any questions about anything here, please feel free to reach out. I'd love to talk to you about this information. But with that, I'll say thank you and bye.